Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Yuri, it's so great to have you on today. Thanks for being on.
Thanks for having me.
No problem. So during our prep conversation, I really enjoyed just hearing really your global background, like being born in Seoul and raised in Budapest, and then later coming to the U.S. for school. I was wondering, like, how did those experiences have really shaped you as a person, and then also as an investor?
Yeah, that's a big question to start with. But yeah, I mean, obviously it shaped a ton. Few things that come to mind though. One is just like the deep belief that talent can really come from anywhere. All corners of the globe, like all backgrounds, like all those things. And I think for me, like when I evaluate founders or GPs or just people in general, it's a good reminder to think about what people have accomplished relative to where they've started. I think I think in the context of founders, for example, like founder who started in a different country and came to the U.S. is just going to have a different experience than somebody else who may have grown up in the U.S. So like things like that. And so I think about that a lot when I'm evaluating people. The other thing is, I think like it really did give me the love for technology. Like I think technology is such a democratizing force. Growing up, like when I was a kid and when I was a teenager, most of my friends that I made were actually online, like through video games and through forums and things like that. And so it was just like such a positive force in my life, and made it available for me to make friends anywhere. And when you look at founders today, like people can build anything with software and AI more and more. And so just I think I have like this super positive, I would say, like tilt or like perspective on like what technology can do for people in society, which I think you kind of need for venture anyway. So
based on sort of that love of technology, does that translate into some of the areas that you focused, specifically when you were in the VC seat, or where you continue to like to focus? Like, do you see those areas of interest?
Yeah. Some yes, some no. I think so. When I was at IVP, I spent time across everything. Like IVP is a generalist firm, but one of the areas that I spent a lot of time in was consumer, actually. And so, I kind of alluded to some of my background in consumer. Personally, I also was a game developer before, and so I spent a lot of time, with consumer founders. And then I think broadly, just like user experience, I think is something that it made me really appreciate and care about when investing. But at IVP, I mean, spent time across both application layer and just broad like enterprise software as well. So, yeah.
Are you feeling a shift with the SaaS apocalypse? A lot of people are sort of saying like, oh, I've always been doing consumer too, or like, and we're looking at consumer now too. Or have you been noticing this trend? And you're going to say like this, I'm OG.
I think I actually feel like I think consumer is still pretty non-consensus. I mean, maybe it's because it's coming back a little bit more, but from my conversations in the last, whatever recent months, like everyone wants to do deep tech or whatever you want to call it, but things that are adjacent to AI but not software. So whether that be investing in like the picks and shovels, like all the way down to like energy and power, semiconductors, like all these, all those sorts of like adjacent physical industries. Yeah.
It's fascinating. Every moment I've been in this industry for the last almost dozen years, we find new four-letter words of like, oh, you can't say consumer, or you can't say SaaS now. You can't say, when I was starting out, they're like, oh, you do vertical SaaS? Oh, you do verticalized? That's so disgusting. But it's funny because we know things are cyclical, and you have to have conviction and kind of see where things are going, and things are ever changing, especially with AI, the technological shift. So I'm curious, from your seat as now you've known the tricks and tips that VCs have done in the past. How does that shape your view as a allocator now?
Yeah. I think for me, one of the biggest things is I think a lot about the underlying portfolios and companies that are in venture books, probably more than the average LP. I mean, part of it is because I'm not as good at some of the things that probably more institutional LPs who've been doing it for a long time are, like the portfolio construction and thinking about those sorts of things. But I spent a lot of time on, portfolios. Like, I don't just take marks or things as they are, right? Like, thinking about underlying, like, what is the quality of that business, like, metrics and how those might be relevant to one business but not another, like those sorts of things. And so, evaluating portfolios in the like investing lens of like how I would as a growth investor has really helped me as an LP. Yeah.
What was the sort of deciding factor for you moving from the VC side to the LP side? What are you doing now at your new job?
So for me, the move was really about building something. So TMRS is a large institution, but we're building something new within that institution, which is a really unique and privileged position to be in, where, TMRS is a $50 billion fund, and so we're large, but we're not so large that our checks don't matter. Or rather, our checks are large enough that they matter, but they're not so large that we can only invest in like a very small group of folks. And so that was really unique. And part of what we do is, we are investing in funds, but then we're also building out this co-invest / direct program. And so getting to build that part out just sounded really fun and like a new challenge that I wanted to take on.
How did you approach the kind of like, once you got the role, like, where do you even start? And the reason I ask that is we have so many allocators who are listening who are presented with starting a venture or private equity book. And I think, your lessons learned could probably be really appreciated.
Totally. So the high level mandate to like context that a little bit, TMRS is a roughly $50 billion trust. Of that, about 3 billion of it is allocated towards venture and growth. And it's a growing portfolio. So for context, TMRS historically had a very conservative portfolio construction. So like even like up until, I don't know, 2010 or something, it was mostly fixed income. And so we've been growing private equity as a portion of the portfolio. And so 3 billion is sort of like the end state that we're trying to get to on the venture and growth side. And so we have, several hundred million to deploy into venture and growth each year, writing 10 to $100 million checks. And that was kind of like the high level mandate that we were given. Like, hey, like we're growing the private equity portion and the venture and growth portion. On the fund side, what that actually looks like from a portfolio construction perspective. So there's two sort of buckets that we think about. One is the early stage side, and then the second is multi-stage / growth. The multi-stage and growth is going to be larger checks, fewer managers. Early stage is going to be smaller checks, more managers. And the growth side provides what I would consider like positive venture beta. So like most of, these multi-stage managers aren't going to be 10x funds, but hopefully you're kind of capturing like what is like top quartile, like good, like hopefully more reliable types of returns. And then the early stage side, you're getting a little bit more variance, but hopefully you're also being able to capture some of these like really outlier funds that are going to be super accretive to the overall returns.
And for the earlier stage folks, a lot of the people listening to the show are emerging managers in fundraising mode. What's the spiel? Like when you hop on a meeting with them, what are they going to hear from you so that they can come prepared?
I think for us, like we are in this net new adding mode, right? Like we're trying to have more early stage exposure. And so that's one, which not everyone is, right? Like, I mean, when I talk to a lot of LP friends, there's a lot of folks who aren't adding dollars on venture. The second thing is we want to focus on the early stage side. We really want to focus on folks that are having um, outlier ideas. Like I think right now there's a lot of consensus in venture. So like if you look at a lot of venture portfolios, like multiple managers are in lots of different like are in the same names. And so even though you have multiple managers, you're actually getting exposure to the same companies like over and over. And so folks who have like a differentiated perspective and then therefore a differentiated portfolio is something that we're really looking for. And then thirdly, like the way that I evaluate managers and think about them is in the context of one, can they really articulate like the differentiation that they have? So whether that may be sourcing, picking, or winning, like what is your sort of edge? And then how do you translate that into your fund strategy? So like I think about it like product market fit. Maybe this is because I was a venture investor before, but um, I think surprisingly, like a lot of managers don't have product market fit where the product that they're selling doesn't match the edge that they have. So, for example, like if your edge is you have like really great access to technical AI talent that's young, and you're raising like a $400 million fund, and you're going to put half of it into growth stage companies, like that probably isn't going to match like what you know what your edge is. And so that's something that I think about a lot when evaluating managers.
You mentioned the framework of sourcing, picking, and winning.
Yeah.
Um, I personally have think that those three have their importance really depends on kind of like the edge of the person and who they are and what they do, but then also even just like where we are in eras. And so, which of those three do you think are most important for the early stage managers you're looking at? And then, which three do you think are the most important for those kind of more established later stage
Yeah.
firms?
So in the early stage, I do think sourcing or seeing the right opportunities just does generally tend to be the most important. Like if you're just not seeing the right opportunities, you're not going to get to invest. That is probably the most important. And then winning to me is just converting that access into ownership. And so probably those two I would say are more important than picking. I think maybe some early stage, I don't know if you guys would disagree with that, but it's so often that people think like okay like this is like the best idea or this is the best team and then like a few years later you find that your portfolio is very different than what you expected would be like the great companies versus the not so successful companies. And also part of it there is like an element of luck in it, so I think those two are probably the more important ones. And then for the multi-stage or more established managers, I do think picking does end up becoming a lot more important. um, and you can definitely pick wrong in the growth stage, and if you pick wrong many many times, then your portfolio isn't going to be great. um, and also like when you pick like an art, like part of the art of picking is also being able to size correctly, right? Like it's there is like an element of winning and making sure you get the ownership that you want, but also like being able to double down on things that you like really believe in and are you believe are going to have outsized returns is a portion of picking too. So I think that's becomes more important as you get later down sort of the funnel.
Now that you're receiving these pitches,
Hmm.
is there anything where you just realize, oh man, GPs don't get my job? Like they're just like coming in here hot, uh, rattling off their strategy. Is there
Yeah.
something that they're kind of like missing that you're like, like what I need is actually X?
I don't think there's like one unifying thing that people miss, like, oh, like I see everyone misses XYZ. Um, but I do think that in general, GPs tend to have like a relatively rehearsed pitch, I would say.
Hmm.
And so, like, what that ends up doing is over time, almost all pitches sound basically like very similar, where they're like going after, okay, they're saying, first this is like my background, and then here's my portfolio, and then this is how I think about investing. And so like it ends up being like all sort of similar. And so what I end up having to look for is like, okay, did this person say something? Um, did they have a unique insight, or did they say something unique that was different than everyone else? Um, so I would say I would encourage like more of of approaching each conversation as like a different conversation. And and I think the other thing too is, for me, like I really care to talk about the companies. This is my personal bias.
Mm,
I don't know if
yeah.
everyone else has this bias, but I really care to talk about the companies. Like, why did you invest? Like, how did you win that founder? Like, all these sorts of things, because that tells me the most about how that person thinks about investing, more than some of the kind of like rattle off the facts part of it. But I think a lot of people tend, it's easier to just kind of index on sort of the facts of what's going on. Yeah.
Yeah, just kind of like going through the DDQ checklist and
Yeah.
and getting those answers. Are there
Yeah.
any other questions or areas you like to really dig into that you feel like you get a real perspective on the differentiation, or if you want to really invest in this fund manager?
Yeah. Um, so I mean, outside of the companies, so I mean, maybe going back to that framework of sourcing, picking and winning, there are like a few sort of differentiators that like I'll look for in those individual areas. So, for sourcing, for example, like, does this person have, like, one differentiator could be, does this person have a proprietary network that they have access to that no one else has access to? So like that's something that I'll dig into with them, but then also through reference calls and understanding like where they are in the ecosystem. Um, Another thing could be like within sourcing. So like one is like proprietary access, but another could be like, are you seeing this deal before everyone else?
A lot of our listeners have not had an institutional fundraise. Could
Mhm.
you give them a couple insights into the process? Like
Yeah,
what's going to be different working with a pension?
totally. Um, so pensions have some requirements that are set by, state law, or just generally like they're governed by the like states, compliance and regulatory and these sorts of mandates. And so um, that creates some unique challenges on the legal side of it, where there might be side letters or things like that that are something just to be aware of. And then often pensions will work with a partner to outsource some of the diligence. Um, and part of it is outsourcing, but then also part of it is like to have like auditing of the work that you're doing. And so um, often we don't do this for every manager, but often they'll have an IDD partner and an ODD partner who will independently also sort of verify the work that we're doing internally as a team. And so just being aware of, I guess, those three dynamics, the legal slash compliance side of it, and then the ODD IDD dynamics, which just end up taking a little bit more time and are a little bit more complicated than maybe some of the other institutional investors out there or non-institutional investors out there, is good to know.
Yuri, before we continue, for our listeners that may not know, what is IDD and ODD?
Oh, sure. So IDD just stands for investment due diligence, and ODD stands for operational due diligence. So IDD is kind of what we, like the bread and butter of what we do. So all the things that I talked about of, how do you evaluate a fund manager? But then we'll have a third party sort of independently be doing that alongside of us. Again, like not every pension does this for every manager, but that is a process that exists. And then ODD, operational due diligence, is basically making sure that the fund that you're setting up is a entity that is set up for success, that can interact with institutions, whether that be controls around how do you think about managing your cash, like managing your organization, like do you have the right like cybersecurity, like have you thought about the risks that just come with operating a fund?
Now we're going to take a quick break to speak with our sponsor.
What compliance priorities should emerging VCs focus on first?
When a manager enters the space, one of the things that they should look at first is where they may have conflicts of interest. A lot of the regulatory framework from an SEC perspective, if you look at it under the Advisors Act, you're really going to have all of these rules which really are asking the question, is there a conflict of interest here between the advisor and its client? And when we think of the advisor's client is the pooled investment vehicle, we need to look at how the conflicts may evolve or develop between the manager and its efforts and its fund client and the portfolio companies that are under that fund. And so really kind of looking across at where those conflicts may exist. That could be, where are you helping portfolio companies? And what do expense reimbursements and what do valuations look like when you're working directly with those companies that way? Are you lending personnel into the portfolio companies to help them, manage through challenges or difficulties or growth opportunity? Those are all potential sources of conflicts. And the great thing about the Advisors Act space with private funds and private fund investors is it really is there are specific rules, things you have to do for sure. Like any regulated environment, there are things you must do. But that's a more limited set than other regulatory regimes. The Advisors Act is really in the private fund space focused on that conversation with your sophisticated investor, right? So that qualified purchaser, accredited investor who's come into your fund really is looking to understand what are the things that I need to know about how you're going to manage the vehicle and where you may have conflicts. And so a lot of this can be addressed through disclosure, not everything, but if you've taken the time as you enter the space to think about, well, what are the things I want to do? What are the better business models in this space? And how would I approach building my offering based on what I know is the I would say common and similar approaches? Where in my model would I have some of those conflicts? And how would I talk about them, right? Like, how would we resolve that? How do I want to engage with my investors and talk about how we resolve those conflicts, right? And either mitigate them or eliminate them or disclose, this is the nature of the conflict, this is what it means to you, and these are the things we're doing to mitigate it, right? These are the things we're doing to take the incentive to not work in a way that's aligned off the table, right? We've taken these steps to do that. So I think managers thinking about that ahead of time really puts them in a better space, right? Because they can anticipate having those conversations. The challenge I really run into with some clients, I should say the clients run into the challenge, and we have to work with them to try and resolve it, is they haven't thought this through. So they've developed a relationship, they have a conversation going with the LP, and now there's something that needs to be brought up that, gee, it really would have been much more comfortable in the conversation to have talked about this a little while ago. And if we haven't really thought through the ways in which we have these conflicts where we need to introduce what the relationships are with those potential conflicts and supporting the business, it makes it somewhat challenging to go back to your LPs later and say, hey, look, by the way, should have talked about this, but here it is. It creates some challenges to managing those LP relationships. And it really is more about business and reputational risk at that point than it is necessarily about regulatory. The disclosure is the disclosure. If you get it out there, if you make it, great. But a lot of the tension really comes from, when do we say this? How do we say this? Can we introduce this in a way that feels organic and appropriate and natural for the relationship that we're developing as asset manager and LP? That's really a challenge that I think a lot of folks don't take on early enough.
Yeah. Is there an example of a disclosure that, people listening might say, oh, I really should be thinking about that today?
Yeah, I mean, I think one that a lot of managers miss is when they have portfolio companies that can offer complementary services. So in other words, one can use the other for services. And that makes a ton of sense in a lot of spaces where you're developing a portfolio of portfolio company assets. So from a fund perspective, different businesses that are in a related space. So it may be perfectly natural. Like it would be great. That's even part of the model, right? That we would find ways to develop these synergies across the portfolio companies. That itself presents a conflict, right? Mm-hmm. That basically, as a controlling party of business one, you're going to recommend and instruct that business hire another business that you own and control for its services, right? And so that's absolutely manageable. I'm sure a lot of people who are listening are saying, yes, of course, that's part of what we do. That's why we do this. And that's right. This is part of the industry, is absolutely part of how things are managed, and you even look for those opportunities. But don't forget about the disclosure, right? Don't forget about that those relationships create conflicts, that if you put together a description of how you may do that, how are you going to manage and mitigate some of the conflicts that come up through that? That's great, right? You're out in front of that. And then let's have the more enjoyable part of the conversation, which is, how does this synergy create more revenues, more business opportunity, greater portfolio enterprise value? Instead of getting stuck on, oh, we really should have put this disclosure in front of you a while back so that you know that we're doing these things. I think that's an example where you can get tripped up on it if you're not thinking ahead.
Yep. No, it's YC sort of companies are famous for this, that built in you have this incredible network of early customers who are fellow YC alone. And I could see that you've got to sort of be upfront about that. Another question, what's evolving in how VCs handle marketing and performance reporting?
Yeah, I think we're seeing managers for performance reporting, I think spending a little bit more time thinking about their net of fee disclosures, and how they're presenting what would be case studies, if you think about that under the marketing rule. And if an exempt reporting advisor, VC manager, listens to this conversation and says, gee, why are we talking about the marketing rule? I'm exempt. I don't need to comply with the marketing rule. It's really, the marketing rule is based on a number of anti-fraud and fiduciary principles that developed over a 40-year period, where the SEC put out a number of no action letters, and there were enforcements and so on, and developed this point of view for the fiduciary duty and the anti-fraud principles that the marketing rule is based on. And those really roll forward, right? And so as a VC exempt manager, and if they're registered, absolutely this is going to apply to them. But if you're exempt, you don't have to comply with the marketing rule, but the principles that underlie the marketing rule, which very helpful from the SEC, they put those principles right up front in the rule, right? They called them general prohibitions, and then they spelled out this series of principles-based limitations on what managers can do with their marketing materials. And so that is a really informative read, right? Like, just go through those 7 general principles, and if you think about those while you prepare your marketing materials, that's really going to put you in a good place, right? That will give you the framework for those anti-fraud and fiduciary principles that should be part of your materials. But what does that mean practically? That means looking at things like how you're calculating the return. If you're doing a case study, what are you presenting in those materials? You may not have to comply, you don't have to comply with the specific requirements for presentation of gross and net and so on under the marketing rule. But what you do need to comply with is the idea that the information is not misleading, that you haven't omitted information that would be needed in order to understand what's being presented in the context in which it's being presented. Those are the anti-fraud principles that are right up front in the rule. And that's where you kind of draw back to, look, they set the table nicely in the rule there for a manager to understand, look, these are the things I need to be thinking about. And so when you put together that deck that talks about that great portfolio company that you found and your process for finding it, and what your IRR has been, or if you've got a partial realization and you've got some remaining value there, how do you break that up and show those different parts? Those are things that I would be thinking about. When all of that information makes it on the page, can we look at that and say, yeah, that's going to meet those general prohibition standards that we've provided, with material accuracy, we've provided enough information that it can be read without being misleading.
Mm-hmm. No, it's fascinating that officially the marketing rule does not apply, but there are overarching overarching values that you should be tracking on the
Right.
performance reporting. And now back to our LP interview.
I wanted to learn, you mentioned it earlier that you also have part of the venture strategy is a co-investment practice. Could you talk about how it fits within the overall venture strategy and kind of what the mandate is?
Yeah. So over time, our goal is to move towards 50-50 funds and co-invest/directs. So that's actually I would say that's a pretty aggressive portfolio construction. But granted, it's over time. It's not necessarily all today. The purpose of co-investing in the portfolio, there's a couple things. One is it blends down fees, right? So that's something that practically just helps with returns. The second is we can double down on winners, where, I mean, a lot of venture portfolios, it is actually like there's one or two companies driving the whole value. And so if you're getting additional exposure to those, that hopefully also drives returns. And then third is it allows us to be more offensive in terms of like points of view that we have on where our portfolio is lacking and filling those gaps. So if we think, hey, like we're really missing this portion of AI, like we're underexposed here, like we can additionally double down on some of those themes. And so I would say those are the three things that we think about why co-investing is great. The flip side of it is, right, like it's riskier. You're trading sort of higher potential for returns for higher risk that if things don't go well, then you're overexposed. But obviously we think about that in the confines of how big we write checks and things like that. Yeah.
Well, and it sounds like you're a team that's uniquely qualified to do this. So few allocators are in their swim lane when they're picking individual deals. That's your training.
Yeah. Yeah. And I think, when I think about how we're building, the co-investment program, like the ideal scenario that I tell GPs about is we would love to partner with the best GPs. And then especially because our portfolio is going to be tilted more towards the early stage. As those companies sort of grow up, we would love to know about them ahead of time and then be in a position to invest in them in the later, in those later stages. And so it creates like a really nice, like symbiotic barbell approach, essentially, where we can double down on like a lot of our early stage investors winners. And then the other thing too is, coming from a growth investing seat, like no investing that you do into a company is feasible if you learn about the company and then you have to make a decision in 24 hours. Like those are
Yes.
in growth stage, that's like not, maybe in early stage you can sort of pull that off, but in growth stage that's often not the winning formula for investing in the best companies. And so being proactive about learning the companies in our early stage or actually just generally overall in our portfolio, having a point of view on like what is our most exciting pipeline of those companies, like what would we want to invest in, and then being in a position to, when they raise, already having done some of that work, like that. I think that's kind of like the best practice of what you would do in a regular growth investing environment that we want to try to bring here. Yeah.
Does that then translate to what your valuation entry points you need your managers to be getting into? What recycling strategy they have? Do you sort of have a perfect fit or things you're looking for that then make them a good co-investor partner?
I think we are relatively early in this journey, and so we don't have extreme we don't have guidelines to that level of detail yet. I think generally it's been companies that are so there's been kind of two flavors of companies. One, which is in that, call it $500 to $3 billion valuation range, where it's still in that basically early growth, where we're taking on a little bit more risk. We're going to write smaller checks here and really just lean on our partners and kind of the work that they've done to invest. And then we've also done more of the like true late stage flavor. So, think like the OpenAIs of the world, the Anthropics of the world, like those types of
Those
companies
names,
where
yeah.
where you're honestly just independently underwriting all these companies, right? You're not necessarily saying, oh, because all of our GPs are in a lot of these names, and so you're thinking about them as an independent sort of underwrite, and so there's been multiple flavors of what we've done, and I think there's multiple types of co-investors that can be really good partners to us.
One question I always like to ask when people have decided to do kind of the co-investor strategy is, what do you feel that you can learn from previous renditions, whether you were on the GP side and working with LPs? And there's always this thought of like, how do you make sure that you're top of mind to actually know about these companies, and the adverse selection bias, all those things. How do you
Yeah.
think about building a program that can get beyond those things and actually reach the goal?
Yeah. Um, I mean, adverse selection is something we think about a lot. Like, why do we have this opportunity in front of us? I automatically assume if it's like a Series A and it's, available to us, I'm just by default I'm gonna assume it's not the best opportunity because like those are often very, very competitive. Um,
Yes.
there's the one thing that sort of mitigates that is the time component of it. And so that's why, when I was talking about in the ideal scenario, we want to get to know these companies ahead of time is if if we have a point of view that, hey, this company is really promising or we're really excited about it, and we let, we work to communicate that with our managers, then there might be a way to get allocation in the Series B that, otherwise we would not have had opportunity if it was an inbound. So like generally like those types of opportunities, we want to think about how do we outbound or how do we proactively try to get access versus, hey, like there's a few million left over, and then my question is why. And then the other thing is, so the time component, I think that's actually like I think that's the biggest sort of gap in terms of LPs being able to build co-investment programs is just when you're reacting to everything inbound, the adverse selection is really bad, and you just don't have time to evaluate. The second part of it is information. I think one thing that I've been surprised by on the LP side is just how much less information you have relative to the GP side, and especially in venture where a lot of times you're underwriting founders. The best founders, like they're not trying to do like 10 LP calls as well on top of the investor calls that they've done, and so there's like that sort of component of not having as much face time with founders.
I love your point that you're like, it's only going to be one or two names in each fund, but how do you sort of pick those out given that early signals can be a little bit messy and
Yeah, I definitely don't think it's clear. I mean, if it was super
Yeah.
clear, then it would be really easy
Yeah.
to be a or to just be an investor in general. I don't think it's super clear. I think it's about finding ways to systematically track them. So, for example, like one thing we'll do is quarter over quarter when we're getting investor updates from our early stage partners, constantly tracking like what they state as the most exciting company in their portfolio, and then how do those companies perform over time. So like there's no real shortcuts here. Like it's the same thing that you guys do and it's the same thing that growth investors do. We're trying to track those so that we can narrow it down to a list of a few companies that we're excited about. It's not going to be, okay, there's this one company and we know, because if we did know that, we would just invest then, right? Or we would try to find a way to invest right there. Yeah.
How is the consensus seeking at the earliest of stages, or how it feels just from outsiders when I talk to like family offices or even international kind of like fund to funds, is the U.S. market is becoming more and more kind of party round-ish. Um,
Yeah.
how does that impact kind of how you think in diligence for your co-investor program?
There's two things. One is, um, if it's the case that it's a very consensus company, then we are trying to get there at like the lower price, right? Like that's kind of what you're solving for, is trying to get there at the lower price, get the most ownership possible, right? Like that's what the managers are solving for as well.
Yeah.
Um, and I would say honestly for those types of rounds, that's like where we're trying to solve for managers as opposed to necessarily getting co-invest. One, because co-invest often is not available. Um, but two, like you don't really know how those consensus companies will shake out. You're just trying to build a basket of good co-invest or good consensus companies. And so that's I guess like that's how I think about it. And then on the manager side, so we want to have two types of managers. We want to have managers who do consensus, and then we want to have managers that have non-consensus ideas. And you want to have exposure basically to both. And those non-consensus managers, you want them to have sort of like different edges of access that aren't just what everyone else is going after, and you're kind of compensating for that risk with lower valuations on those companies. So I think you have a manager profile that can cover both of those, and then on the earliest stages, you're kind of most people are more programmatically co-investing in these companies as opposed to trying to be super like a super picker. I mean, the investors themselves are having a hard time picking here. We're not gonna pretend that we're gonna know more than them to be a super picker in that sort of field. That was a little roundabout, but hopefully
No,
that
no,
makes
no. That no. I appreciate. First of all, I appreciate the candidness of like when you're picking in a consensus like batch, you want to get the best consensus, and it's no guarantee that they're all too big to fail, right? Like I don't think people
yeah.
talk about that as much. And then I appreciate your perspective on like, all right, how does this world now impact what you look for in different managers from the kind of archetype of differentiated non-consensus managers? Is there certain strategies you've been surprised you haven't seen more of?
I mean, the thing about non-consensus that's really hard is it's very, very hard to put it into any sort of buckets, right? Like they're outliers for a reason. So
Yeah.
um, I don't think there's been one type that is. I'm surprised there's not more of X or Y. Um, it's the more like non-consensus, it is, the more I'm looking for how strong is their edge or unique sort of insight into that market or into that founder archetype or whatever that is. So leaning more into that versus I've never seen it before.
I would just love to see like the crystal ball Yuri approach of like what is gonna happen to AI investments that are out now. Like you've been talking about these consensus names,
Yeah.
and we don't have that many growth investors on the show, and so it's like as early stage investors, where is this going so that we are getting in at the right, like what is left that
Yeah.
people should be investing in early stage?
Yeah. This is such a hard question because I feel like I'm humbled every month. Like we're so wrong. Like you just have to revisit your priors constantly. Like when the AI wave was sort of first taking off, there was a very prevalent view that many investors, including myself, held that investing in the model companies was not good because those were not real businesses. They weren't going to have differentiation over time, and application layer companies were going to take the share of value. And fast forward to today, like that's pretty wrong. I guess jury's still out ultimately, but it feels wrong, right? Most of the value seems to have accrued to a lot of these labs who have managed to go up to the application layer pretty significantly.
Yeah,
And
Perplexity just advertised to me like, here, give us all your personal health data, and you've
yeah,
got like Anthropic doing the lovable competitor overnight.
totally.
You're like,
It's like, and even within OpenAI and Anthropic, like I mean, the narrative shifts and what's been happening today, like it's pretty crazy to see how wrong like what seems so right in the moment can be. And so part of it is I think we're all like knowing what you don't know is like really important, and just constantly re-examining your assumptions is something that I've been thinking about a lot. But when it comes to what we're actually looking for in the growth investor lens, I mean, it just comes down to over the long term, can you sort of state and understand what are the enduring moats of this business? And I mean, that's like, again, that's like not like a magic formula answer. I do think that is the obvious answer, but it's also still the truest answer.
Is there one kind of like, for anybody who makes that GP to LP transition, one point of advice that you have for those individuals?
I think the biggest thing that I've realized personally is, so when I was on the GP side, I was primarily doing outbound, right? Like I was chasing founders. And now I'm on the receiving end of it, where I'm receiving a ton of inbound, trying to say no to people and figuring out what is like the right thing to do in a set of many choices, as opposed to before when I was just trying to go out and find the right opportunities. And so it gave me a lot of empathy and appreciation for the founder side of the table as well, where I think they're also in receiving tons and tons of inbounds from lots of GPs and trying to sift through and figure out how are they different and all those sorts of things. And so in that transition of GP to LP, like the biggest thing is just around empathy for the different parties and like the different, why they're motivated to do the actions that they're doing, and kind of meeting them where they are in that sort of part of the funnel, if that makes sense, So that's probably my biggest piece of advice.
Super fun parallel that like the growth investor is like the LP trying to get into those like dedicated big brand names.
Yeah.
And the seed investor is like the LP allocating into emerging managers, where like there's literally thousands of you.
Exactly. Yeah.
Yeah. And then I'm sure you're also getting the random also inbounds that are for things that like you're never going to do, like a real estate fund or whatever.
Exactly.
You're like,
yeah.
I don't do that, but thanks. Thanks so much, Yuri. What a joy.
Yeah.
Thanks, Yuri.
Thanks so much. Thanks so much for having me on, you guys.
See you later, alligator.
After Portfolio Tile, investing with a smile.